Short selling is an investment strategy that involves selling borrowed assets, usually stocks, with the expectation that their price will decline. In a short sale, an investor borrows shares from a broker and sells them in the open market, with the intention of buying back the same shares later at a lower price. The goal is to profit from a decline in the value of the borrowed assets. The process of short selling typically involves the following steps. Borrowing shares. The investor borrows shares from a brokerage firm or another investor who owns the shares. The borrowed shares are sold in the open market. Selling in the open market. The investor sells the borrowed shares in the open market, effectively taking a short position. The proceeds from the sale are held in the investor's margin account. Buying back shares, covering the short. At a later time, the investor aims to buy back the same number of shares in the open market. The goal is to buy them at a lower price than the price at which they were initially sold. Returning borrowed shares. The investor returns the borrowed shares to the lender. The difference between the proceeds from the initial sale and the cost of buying back the shares represents the investor's profit or loss. Short selling involves a bearish outlook on the price of the borrowed assets. If the price of the assets falls as expected, the short seller can buy them back at a lower cost, making a profit from the difference. However, if the price rises, the short seller may incur losses, as they would need to buy back the shares at a higher price than the initial sale. Key points to note about short selling. Limited profit potential. While potential profits from short selling are theoretically unlimited, as a stock's price can theoretically go to zero, the potential losses are unlimited since there is no upper limit to how much a stock's price can rise. Margin requirements. Short selling typically requires the investor to hold a margin account with the brokerage. This involves maintaining a certain level of funds or securities in the account to cover potential losses. Risks and challenges. Short selling involves higher risks and complexities compared to traditional long investments. It requires careful timing, as the investor needs to anticipate market movements correctly. Short squeeze. In certain situations, a short squeeze can occur, where a rapid increase in the stock's price forces short sellers to cover their positions by buying back shares, further driving up the price. Not suitable for all investors. Due to its higher risk and complexity, short selling is not suitable for all investors, especially those with a low risk tolerance or less experience in the stock market. Regulations and rules governing short selling vary by jurisdiction, and investors should be aware of the specific requirements and restrictions in the markets they operate in. Short selling can be a speculative strategy and should be approached with caution and a thorough understanding of the associated risks.